Simplified due diligence (SDD) measures. Risk-based AML CFT measures for money or value transfer services (MVTSs). Financial institutions (FIs) are required to implement robust customer due diligence (CDD) measures commensurate with the risks associated with business relationships and transactions involving money or value transfer services (MVTSs). This obligation applies to both foreign and domestic MVTSs and includes similar entities involved in securities transactions or funds transfers. The following guidelines outline key measures FIs should consider. 1. Licensing and registration. Ensure that the MVTS is properly licensed or registered. For Hawala providers, FIs must verify the original registration certificate issued by the central bank and retain a copy. 2. AML CFT policies and controls. Assess the adequacy of the MVTS's anti-money laundering (AML) and counter-financing of terrorism (CFT) policies, procedures, and controls, including those related to wire transfers. 3. Agent information. Obtain and review the MVTS's list of agents. Evaluate associated money laundering (ML) and terrorist financing (FT) risks, especially concerning high-risk countries or factors. 4. Business and risk assessment. Collect comprehensive information on the MVTS's ownership and management structure, considering potential politically exposed persons, PEPs, the scope of its business, its customer base, and geographic operations. Identify, assess, and mitigate associated ML/FT risks. 5. Risk-based internal policies. Develop internal AML/CFT policies, procedures, and controls appropriate to the assessed risks. Ensure that these policies are documented, approved by senior management, and communicated to relevant staff. Risk-based AML/CFT measures for non-profit organizations, NPOs. Non-profit organizations, NPOs, can pose significant risks in terms of money laundering, terrorism financing, and other illegal activities. Financial institutions must apply rigorous due diligence measures tailored to these risks. Here are key measures to consider. 1. Licensing and registration. Confirm that the NPO is properly licensed or registered. For account openings related to donations, obtain an original signed letter from the Ministry of Community Development and authorization from the UAE Red Crescent for financial transfers out of the UAE. 2. AML/CFT policies and controls. Assess the adequacy of the NPO's AML/CFT policies, procedures, and controls. 3. Regulatory and supervisory status. Gather information on the NPO's legal, regulatory, and supervisory status, including regulatory disclosure, accounting, financial reporting, and audit requirements. This is especially important for NPOs involved in community, social, or religious activities in jurisdictions with limited transparency. 4. Ownership and management structure. Obtain detailed information on the NPO's ownership and management structure, considering potential PEP involvement, its activities, donor base, beneficiaries, and geographic operations. Identify and manage ML/FT risks associated with these factors. 5. Background checks. Perform thorough background checks on key individuals, such as senior management, branch managers, major donors, and beneficiaries. Use internet searches, public databases, and subscription services to screen for adverse information and matches with financial sanctions lists. 6. Risk-based internal policies. Develop and implement AML/CFT policies, procedures, and controls appropriate to the assessed risks of dealing with NPOs. Ensure these policies are well documented, approved by senior management, and communicated to relevant employees.